Hello, and welcome to the CFRA Thematic Insights, where we explore the market trends and investment themes shaping tomorrow's opportunities. I am Jed Lemen, and today I'm going to be discussing the Canadian macro environment and how it's currently uniquely positioned. Canada's economy is at a bit of a crossroads. After years of aggressive policy shifts, trade disruptions, geopolitical crisis, the question begs, where do we go from here? So what I want to do is quickly break down how we got here and where we may be going, and which sectors are positioned to win and lose. Canada's current environment traces back to post-COVID policy decisions. To jumpstart recovery, the government opened the immigration floodgates. In 2023, population grew 3.2%. That was the fastest since 1957, and about 98% of that came from immigration. Now, the problem was job growth just couldn't keep pace. Unemployment climbed from 5.7 in early 2024 to over 7% by late 25. That was the highest since 2016, excluding the pandemic. And during this time, the Bank of Canada fought inflation pretty aggressively, right? They hiked rates from near 0 to 5%. So this, combined with fiscal measures like the GST holiday and the carbon tax removal, that helped cool inflation down to around that 2% range. But GDP growth slowed dramatically too, from 6% in mid-2022 to under 1% by late 25. Then came tariff chaos, U.S. trade policy whipsawed markets throughout 2025, right? Good exports to the U.S. dropped nearly 6%. And even after the Supreme Court shot down the tariffs in February of 26, the damage was done, right? Canada's share of export to the U.S. had fallen from 76% to 72%. And that direction is now status quo. Now we have a new shock, the U.S.-Iran war. Crude prices have surged 45% since late February, and gas prices are up about 30% in Canada. Now, this is a double-edged sword, because higher energy costs will likely push core inflation back into the mid-2 range, and possibly higher if it drags on. This could crimp growth in eastern provinces like Ontario and Quebec, but western provinces like Alberta and Saskatchewan, they produce a lot of crude, and they stand to benefit. The crisis has maximized the Trans Mountain pipeline capacity as these upstream producers in Western Canada ramp up production to meet this unique opportunity. So the net GDP impact is actually roughly neutral, but the inflation risk is very real, and every week without resolution raises the stakes. Crude pricing being higher from the Strait of Hormuz being closed benefits and harms different industries. However, if it doesn't get resolved, then global demand degradation will impact all industries. And when that comes and how severe that is remains to be seen, but it's something that we're very focused on. Now, so as of this moment, where should investors look? We believe that outperformance lies within consumer staples, right? As wallets tighten, discount retailers win. So Loblaw, George Weston, these are names that are scaling up value offerings, and we've recently upgraded both of them to buys. Utilities, right? Inelastic demand makes this sector a classic defensive play. Rate-regulated names like Hydro One and Emera, they offer stability. They offer growing exposure to markets like Ontario and Florida. So we like them right now. Insurance, particularly property and casualty insurance, right? Drivers must stay insured regardless of gas prices, but they'll probably drive less, which means fewer crashes, fewer claims, and better loss ratios. So Intact Financial and Fairfax Financial, we think they're well positioned here. On the underperformance side, we think within trucking, companies like TFI International potentially face demand headwinds. Recently, fewer trucks on the road has increased rates, and they've performed well due to higher crude pricing. But like we said before, should this persist, you will see demand degradation, and that will hurt them. Within the world of aerospace and commercial flight, CAE and Bombardier are exposed to weakening demand for pilot training, private jets, right? As fuel costs rise, input costs and part costs and supply chain constraints increase, and that could really hurt both of these names as well. So overall, Canada is navigating a pretty difficult macro environment, but it's also uniquely positioned, right? It holds a lot of abundant natural resources, and it's made a significant amount of new trade partnerships under Prime Minister Carney. So it ultimately offers this stable Western alternative in what is a fluid, fragmenting global order. So key for investors in this moment, and should this persist, is to stay defensive and stay selective. Thanks.